Hello and welcome. Today we're diving into one of the most important but often misunderstood topics in all of investing: asset allocation. If you've ever wondered how professional investors decide where to put their money or how you should decide what to do with yours, then this video is for you. We're going to go on a journey together, breaking down not only what asset allocation is, but why it matters and how it connects to your financial goals. Along the way, we'll cover some big, sometimes intimidating sounding concepts. Words like investable assets, correlation, volatility, expected returns, risk tolerance, time horizon, and more. Don't worry, we'll take each one step by step, in a simple conversational way. We'll also explore what it really means to maximize your probability of success as an investor, and how your own personal spending needs, whether they're none, lumpy, or a steady inflation-adjusted stream, affect how your portfolio should be designed. Now, this isn't a 5-minute video. Asset allocation is at the very heart of investing, and to understand it well, we'll need to take our time. Think of this as more like a masterclass in plain English. By the end, you'll walk away with a much deeper appreciation for how investors think about building portfolios, and more importantly, how you can think about building yours. So let's get started with the foundation: investable assets. Section 1. Investable assets. When most people first think about investing, they picture the what: stocks, bonds, real estate, maybe even gold or other commodities. But before we can talk about what to invest in, we need to pause and ask, what do you actually have to invest with? That's what we mean by investable assets. It's the pool of money that you can set aside for investing, after covering your essential needs like food, housing, and emergency savings. It might sound obvious, but it's actually the foundation of everything else. Your investable assets are like the raw material. A sculptor can only create a statue out of the block of stone they have. If the block is small, the sculpture will be small. If it's large, the possibilities are greater. Now here's where things get interesting. The amount of investable assets you have not only affects how much you can invest, but also what types of investments you're even allowed to access. You see, in many markets, there are two special categories of investors: accredited investors and qualified purchasers. These categories exist because certain types of investments are considered more complex or riskier, and regulators want to make sure only investors who can afford the risk are allowed in. If you're an accredited investor, it usually means you meet certain income or net worth thresholds. This status allows you to participate in private investments that aren't registered for the general public. If you're a qualified purchaser, the bar is set even higher. Qualified purchasers generally have larger amounts of money to invest, and that opens the door to an even wider array of opportunities, like private equity funds, hedge funds, or direct participation in specialized deals. So depending on your level of investable assets, your menu of investment choices might look very different. Imagine walking into a restaurant. If you're a regular guest, you see the main menu: stocks, bonds, mutual funds, ETFs, maybe some real estate. But if you qualify for the private dining room, the server hands you a second menu. On it, you see dishes you didn't even know existed: private placements, venture capital, structured credit. Now, to be clear, more choices don't always mean better choices. Private investments can be illiquid, expensive, and risky. But the point is, your investable assets determine what menus you get to look at in the first place. And here's something else. Even within the same menu, two people with different amounts of assets might think very differently. Someone with $5,000 to invest might stick to a broad, low-cost ETF that gives instant diversification. Someone with $5 million might hire a team to design a custom mix of public and private holdings. Both are practicing asset allocation, but the context is shaped by the size and nature of their investable assets. So when you sit down to think about your own portfolio, the first step is always this: what's my starting point? What do I actually have to invest? And what kinds of investments are even available to me? Only once you know the answer can you start building the allocation itself. And that brings us to the next building block of asset allocation: correlation. Section 2. Correlation. Let's talk about one of the most powerful but misunderstood concepts in all of investing: correlation. At first glance, correlation sounds like a complicated math term, but really it just describes the relationship between two investments. Do they tend to move in the same direction in opposite directions, or do they just sort of do their own thing? If two investments have a high correlation, it means they usually move together. When one goes up, the other tends to go up too. When one goes down, the other usually follows. If two investments have a low correlation, they don't move in lockstep. One might be going up while the other is flat or even moving down. And if they have a negative correlation, that means they often move in opposite directions. When one investment zigs, the other zags. Why does this matter so much for asset allocation? Because correlation is the magic ingredient that allows investors to create portfolios that are safer than the sum of their parts. Think of it like a sports team. If everyone on the team has the exact same strengths and weaknesses, they might all be great shooters, but terrible defenders. The team won't perform well overall. But if some players are great at defense, some are strong shooters, and some are fast runners, then the team as a whole is more balanced. That's what low correlation does for your portfolio. It balances out the strengths and weaknesses. For example, consider stocks and government bonds. Historically, they often have a low correlation. When stocks fall during a recession, government bonds sometimes rise because investors see them as safe havens. That difference in behavior can reduce the overall volatility of your portfolio. On the other hand, if you fill your portfolio with only technology stocks, you may think you're diversified because you own 20 different companies. But if all those companies tend to rise and fall together, their correlation is high. In that case, you're not really diversified. You're just concentrated in one area. Here's another way to look at it. Correlation is about how investments interact in different economic environments. Some do well in growth periods, others in recessions, others in times of inflation. By combining assets with different responses, you create a portfolio that can adapt to multiple conditions. And this brings us to a subtle but crucial insight. Diversification is not just about how many investments you have. It's about how different they actually are. A portfolio with 50 highly correlated investments can be riskier than a portfolio with 5 uncorrelated ones. This is why asset allocation is often called the single most important decision in investing. It's less about picking the perfect stock and more about combining asset classes in ways that give you the most resilient mix. But of course, correlation isn't the only piece of the puzzle. Even if two assets are uncorrelated, they might have very different levels of volatility. And volatility is where we turn next. Section 3, Volatility. Volatility is one of those words that gets thrown around a lot in finance. But let's break it down simply. Volatility measures how much an investment's price bounces around over time. If an investment moves smoothly, with only small ups and downs, we'd call it low volatility. If it swings wildly, jumping 10% up one month and 15% down the next, we'd call it high volatility. Here's a helpful analogy. Think of driving on two different roads. One is smooth and flat, you hardly notice the bumps. That's low volatility. The other is full of potholes and sharp turns. That's high volatility. Now, why does volatility matter for asset allocation? Because it directly affects how an investor experiences their portfolio. A highly volatile portfolio might generate strong returns in the long run, but in the short run, it can be a roller coaster. And if the roller coaster feels too intense, some investors panic and sell at the worst possible time. This is why volatility is often described as a behavioral risk. It's not just about the math of how prices move. It's about how you respond when those prices move. But it's also important to understand that volatility is not the same as risk. Risk is about the chance of permanently losing money. Volatility is just about the ride along the way. For example, stocks are more volatile than bonds. They bounce around more. But over very long horizons, stocks have historically provided higher returns. So while they may feel risky in the short term, the real risk for a long-term investor might be not owning enough stocks because bonds alone may not provide enough growth. This is why context matters so much. For a young investor with decades ahead, volatility might be tolerable, even beneficial, because it comes with the potential for higher returns. For a retiree who depends on their portfolio for monthly spending, volatility is a bigger threat. If the market drops sharply, they might be forced to sell at a loss just to cover living expenses. And here's where volatility connects back to correlation. If you combine a very volatile asset with another asset that tends to move differently, you can sometimes reduce the portfolio's overall volatility. This is why even conservative investors might hold a small percentage of higher volatility assets, because in combination with other holdings, they can actually stabilize returns. So, to sum it up, volatility shapes the ride, correlation shapes the interactions, and together they form the backbone of how asset allocation works. But as we'll see in the next section, understanding volatility and correlation is only part of the equation. We also need to understand ourselves, specifically how much risk we can actually tolerate. That's where we turn next. Matching risk tolerance to portfolio design. Section 4. Matching risk tolerance to portfolio design. So far, we've looked at the external pieces of asset allocation, things like what investments are available to you, how they interact through correlation, and how bumpy the ride might feel because of volatility. But now it's time to turn inward, because no matter how well structured a portfolio looks on paper, it won't work if it doesn't match you. This is where risk tolerance comes in. Risk tolerance is partly about numbers, but it's also about psychology. On the number side, it's about how much risk your plan can handle. On the psychology side, it's about how much risk you can handle without losing sleep. For example, some investors see their portfolio drop by 20% and remain calm. They tell themselves, this is temporary. Markets go up and down. They wait it out, and their patience pays off. Other investors see the same 20% drop and panic. They feel sick to their stomach and they sell everything at the bottom. That decision turns a temporary dip into a permanent loss. Both investors had the same portfolio. The difference was their risk tolerance. So, how do you figure out your own tolerance? A common approach is to ask yourself a series of questions. How would I feel if my portfolio dropped by 10%, 20%, or even 30%? Would I stay invested, or would I want to bail out? Am I more afraid of losing money in the short term, or more afraid of not reaching my long-term goals? Another factor is your financial situation. If you've already saved more than enough to meet your goals, you may not need to take on a lot of risk. Your tolerance can be lower because you don't have to swing for the fences. But if your goals are ambitious and your current savings are modest, you may need to take on more risk, even if it feels uncomfortable. Otherwise, you risk falling short of your objectives. Think of it like designing a diet plan. A nutritionist might say, here's the perfect meal plan for health. But if you hate every food on the list, you won't stick with it. The plan has to work for you. The same is true for investing. The best portfolio is the one you can actually hold on to, not the one that looks ideal in a spreadsheet, but keeps you up at night. And that's why asset allocation isn't just about squeezing out the highest possible return. It's about building a portfolio that balances growth potential with the emotional reality of being human. But risk tolerance isn't only about emotions, it's also tied closely to your time horizon. Section 5. Time horizon. Let's break this down simply. Your time horizon is how long you expect to keep your money invested before you need to use it. If you're 25 years old and investing for retirement at 65, your time horizon is 40 years. That's a long road. If you're saving for a house down payment in 3 years, your horizon is short. Why does this matter? Because time horizon changes how you should think about both volatility and risk. Over short horizons, volatility is dangerous. If you invest in stocks for only 2 years and the market crashes, you might be forced to sell at a loss when you need the money. That's a real risk. But over long horizons, the ups and downs of volatility tend to smooth out. Historically, stock markets have had plenty of short-term drops, but over decades, they've trended upward. That means long-term investors can afford to take more risk because they have time to recover from downturns. Think of it like the weather versus the climate. Weather can be stormy one day and sunny the next, but climate is the long-term pattern. Your time horizon determines whether you should focus on the daily weather or the overall climate. Another way to put it, time horizon gives you context for risk tolerance. This is also why financial planners often shift portfolios over time. Younger investors may start with more aggressive allocations, more stocks, fewer bonds, because they have longer horizons. As retirement approaches, they gradually reduce risk, adding more stable assets. Another way to put it, time horizon gives you context for risk tolerance. Another way to put it, time horizon gives you context for risk tolerance. That's why some people create buckets. One bucket holds short-term money in safe assets. Another bucket holds medium-term money in balanced assets. And a third bucket holds long-term money in growth assets. Each year, money flows from the long-term bucket into the medium, and from the medium into the short-term, creating a pipeline of stability and growth. This way, your portfolio isn't just one flat design. It's a layered structure matched to your unique timelines. So when you step back, you can see how all these concepts tie together. Your risk tolerance is partly emotional, partly mathematical. Your time horizon gives that tolerance context. Together, they shape the right balance of safety and growth for you. But we're still missing one more crucial ingredient: expectations about the future. That's where forecasting expected returns comes in, and it's where we'll head next. Section 6. Forecasting expected returns. Now, let's talk about one of the trickiest parts of investing: forecasting expected returns. Here's the first thing to be absolutely clear about. Nobody can predict the future with certainty. Not the smartest economist, not the most successful fund manager, not even the most advanced computer model. So, when we talk about forecasting, we don't mean predicting what will happen next week or even next year. What we mean is forming reasonable expectations about what might happen over longer periods, based on the information we have today. In investing, expected returns are shaped by a few key factors. History. Past performance doesn't guarantee future results, but it provides context. Over many decades, stocks have historically returned more than bonds, and bonds have returned more than cash. Valuations. When prices are very high relative to earnings or income, future returns often turn out lower because so much optimism is already priced in. Interest rates. Low rates tend to mean lower expected returns for bonds, while higher rates can raise the baseline for fixed income. Inflation. Higher inflation eats into real returns, so it matters when setting expectations. Economic trends. Things like productivity growth, demographics, and policy can shape the long-term environment. Here's an example. Suppose government bonds are currently yielding 3%. That tells us something important. If you hold those bonds to maturity, your expected annual return is around 3%. It might vary slightly, but you have a solid starting point. Stocks are trickier, but we can look at measures like earnings growth and dividend yields. If companies are expected to grow earnings at 5% per year and dividends add another 2%, you might estimate a 7% expected return for stocks over the long run. Again, none of this is precise, but it helps ground our expectations in reality. Why does this matter for asset allocation? Because your portfolio should be built around what's likely, not what's dreamed of. In other words, there's no free lunch. Asset allocation is all about finding the balance between those trade-offs. And that balance leads us directly into the next big topic: maximizing your probability of success. Section 7. Maximizing probability of success. At the end of the day, investing isn't about chasing the highest possible number on a chart. It's about meeting your goals. Success in investing doesn't mean beating the market or outsmarting your neighbor or picking the hottest stock. Success means having the money you need, when you need it, to live the life you want. So when we talk about maximizing the probability of success, we're really asking, how can we design a portfolio that gives you the best chance of reaching your goals, given the resources, time horizon, and tolerance for risk you have? This is where all the pieces we've discussed so far come together. Your investable assets set the starting line. Correlation helps you combine investments in smarter ways. Volatility reminds you what the ride might feel like. Risk tolerance ensures you can actually stick with the plan. Time horizon shapes how much risk you can reasonably take. Expected returns give you realistic benchmarks. Now here's the key. Maximizing success doesn't mean maximizing returns. In fact, sometimes chasing the highest possible return actually reduces your chance of success because it exposes you to risks you may not be able to handle. Let's use an analogy. Imagine you're crossing a river on stepping stones. There are two paths. One has big stones spaced far apart. If you make it, you'll get across faster. But the gaps are wide, and there's a real chance you'll slip and fall in. The other path has smaller stones, closer together. It might take a little longer, but the chances of making it across safely are much higher. That's the difference between maximizing returns and maximizing success. One is about speed, the other is about safety. And for most investors, safety, defined as actually reaching your goals, is far more important. How do we put this into practice? One way is through scenario planning. Instead of assuming a single return number, investors often look at a range of possibilities: good markets, average markets, and bad markets. Then they ask, how does my plan hold up under each? Another tool is stress testing. You might model what happens if the stock market drops 30% tomorrow. Could you handle it? Would you still meet your spending needs? These approaches don't eliminate risk, but they give you perspective. They shift the focus from chasing returns to building resilience. Because let's face it, markets will always surprise us. There will be booms we didn't predict and busts we didn't see coming. But a well-allocated portfolio isn't about predicting, it's about preparing. When you design a portfolio that's robust across a range of possible futures, you give yourself the highest probability of reaching your goals, even in a world of uncertainty. And this leads us naturally to our next big consideration. Once you've built a resilient portfolio, How do your spending needs shape the allocation even further? That's what we'll explore in the next section. Section 8. Spending needs. We've talked a lot about the input side of asset allocation, what you can invest, how those investments interact, and how to balance return with risk. But there's another side of the coin we can't ignore, what you actually need the money for. Spending needs come in many forms, but we can think of them in 3 broad categories. 1. No spending needs. 2. Lumpy irregular spending. 3. Steady inflation-adjusted spending. Let's break these down. 1. No spending needs. Some investors don't plan to spend their portfolios at all. Maybe they live off other income, or maybe their goal is to preserve wealth for heirs or for charitable giving. In this case, the portfolio doesn't have to generate cash flow. Instead, the focus can shift toward long-term growth and preservation. If you're in this category, you might be able to accept more volatility, because you don't have to worry about withdrawing money during a downturn. You can afford to think in decades, not months. 2. Lumpy spending. Now let's consider a different situation, lumpy or irregular spending. This means you don't withdraw money every month, but when you do, it tends to be in big chunks. Maybe you plan to buy a house in 5 years, or you expect large medical expenses, or you want to fund a wedding or a once-in-a-lifetime trip. The challenge with lumpy spending is timing. If the money you need happens to be tied up in a volatile asset during a market drop, you might be forced to sell at a loss. So, portfolios designed for lumpy spending often include a blend. Some portion is kept in safer, more liquid assets that can be tapped when the lump comes due. The rest can be invested for long-term growth. 3. Steady inflation-adjusted spending. Finally, there's the classic scenario, steady spending, often in retirement. Here, the goal is usually to withdraw a roughly level amount each year, adjusted for inflation, and make it last for decades. This creates a unique challenge. You need enough growth to ensure the money doesn't run out too soon, but enough stability to provide reliable withdrawals year after year. Before we move on to tie everything together, let me pause for a quick moment. If you're finding this video helpful, if you're learning something new, or if the way we're breaking things down makes investing feel a little clearer, please take a second to hit the like button. And if you want more deep dive videos like this, be sure to subscribe to the channel. That way you won't miss future episodes where we keep exploring the building blocks of financial success. Alright, now let's bring all the concepts together in one big picture view of asset allocation. Section 9. Bringing it all together. We've covered a lot of ground in this video. We started with your investable assets, what you actually have to put to work, and the opportunities available depending on your resources. We talked about correlation, how different investments move in relation to each other, and why combining them wisely can reduce risk. We explored volatility and how it shapes the ride, even if it isn't the same as true risk. We looked inward at your risk tolerance and how important it is to design a portfolio you can actually stick with through ups and downs. We layered in time horizon, which changes how much risk makes sense depending on when you'll need the money. We discussed forecasting expected returns not as crystal ball predictions, but as realistic benchmarks to guide your planning. We tied it together with the idea of maximizing your probability of success, building resilience, not chasing the highest possible return. And finally, we looked at your spending needs, whether none, lumpy, or steady, and how they can reshape your allocation in very practical ways. When you put all these pieces together, what you get isn't just a portfolio, it's a blueprint. A personal strategy designed to carry you through uncertainty and toward your goals. So here's the real takeaway. Asset allocation is not about perfection. It's about preparation. It's not about predicting the future because nobody can. It's about preparing for a range of futures with a design that gives you the highest chance of success. Now, we'd love to hear from you. What's your personal time horizon? And how does it shape the way you think about investing? Drop your thoughts in the comments. We read everyone, and your perspective might help someone else who's watching too. And if you haven't already, don't forget to hit that like button and subscribe for more deep dives into investing and financial planning. Thanks so much for spending this time with us. Until next time, take care and keep building your financial future with purpose.